One of the world's most prominent fund managers is sounding the alarm on a looming crisis. A super bubble, meticulously inflating for over 10 years, now teetering on the precipice of implosion. Jeremy Grantham is the co-founder of GMO, an institution that foretold the Japanese crash in 1989, the dot-com debacle in 2000, and the worldwide financial cataclysm of 2008. Grantham's warning carries weight. As a sage observer of market trends and economic shifts, his proclamation serves as a stark reminder of the fragile equilibrium, urging vigilance and preparedness in the face of a potentially transformative rupture. He's now warning about a potential crash in asset prices that resembles a previous event. Speculative technology stocks are positioned at the forefront of this impending decline. The signs of this downturn are already evident. Wall Street's tech-heavy NASDAQ has experienced a 12% decline from its peak in November, while the broader S&P 500 index has retreated by almost 7% from its record closing high. This could mark the beginning of the bursting bubble, where high-risk stocks, which tend to rise significantly more than the overall market during good times, start to fall as the market climbs. Last year, for instance, even when the broader S&P 500 index surged by 25%, many of the riskiest stocks from 2020 were already on a downward trajectory. This downward trend was initiated early last year, impacting the most excessively speculative stocks first, which were hit the hardest. Subsequently, other stocks followed suit, experiencing declines one after another. Now, approximately 40% of all NASDAQ-listed stocks are trading more than 50% below their previous highs. Before we dive deeper, make sure to hit that like button and subscribe to this channel for more incredible life-changing content. Now, let's move on. Such occurrences are indeed quite uncommon. Historical instances like 1929, 1972 preceding a significant downturn, and 2000 before the tech crash are notable examples. The process of a major bubble bursting seems to be in progress, as evidenced by the substantial decline in value for many of the most speculative stocks, with their values plummeting by at least 50% from their peak. The current state of the U.S. market bears a striking resemblance to the dot-com bubble and subsequent collapse. However, much like in 2000, it's not solely the speculative stocks that are excessively overpriced and vulnerable to a fall. Considering these factors, it's improbable that the market won't experience a 50% decline from its peak, especially the broad S&P index. It would be unusual if the speculative stocks didn't perform even worse than that. Slightly over a year has passed since the previous stock market crash, leaving investors pondering the possibility of another downturn. As the impact of fiscal stimulus diminishes, economic momentum is slowing down, leading to a noticeable decline in equities. Lingering concerns include labor shortages, strained supply chains, and the transfer of inflation to consumers, creating an environment that should raise caution. Interestingly, retail traders appear to be the sole group enjoying positive results. Following the S&P 500's peak in early 2022, U.S. stocks have already decreased by approximately 15% due to central banks raising borrowing costs. More substantial declines are anticipated shortly. Optimistically, a decline of around 27% from present levels could be expected, as suggested by Grantham. However, in the worst-case scenario, a plunge exceeding 50% is plausible. The trough might not be reached until well into the following year. Notably, analysts from Bank of America and Goldman Sachs predict that the S&P 500 will conclude 2023 only around 2% lower than its recent closing value. Conversely, Morgan Stanley envisions a decline nearing 5%. The overvaluation of assets extended beyond stocks, encompassing government bonds, real estate, and cryptocurrencies due to the surge in risky investments fueled by cheap money. This widespread optimism has the potential to lead to a particularly severe reckoning, An instance of this is the recent failure of Silicon Valley Bank, partially triggered by losses incurred on bond holdings due to rising interest rates and falling U.S. government debt prices. Grantham predicts that as the bubble loses air, it will inevitably usher in an economic downturn. Throughout history, each period of excessive market exuberance and overpriced bubbles has been succeeded by a recession. The severity of these recessions varies. They can be mild if all the right measures are taken and complications are avoided, but they become severe if mistakes are made. Investors should prepare for unexpected developments. The implosion of Silicon Valley Bank, or the necessity for the Swiss government to intervene and execute an emergency rescue of Credit Suisse, were events that would have been difficult to predict. The collapse of major bubbles places immense strain on the system, comparable to pressure building behind a dam. It's challenging to anticipate which part will give way. The correction in the bond market might be nearing its conclusion, yet stock valuations continue to significantly exceed any conventional long-term correlation with corporate performance. Strain within the financial system may escalate when the U.S. economy slides into a recession and corporate profits start to decline. Federal Reserve economists anticipate a relatively moderate recession by late 2023 due to the repercussions of the banking crisis. Even within this challenging context, money-making prospects will emerge. However, in the immediate term, the readjustment of asset prices to more reasonable levels will result in nearly everyone experiencing losses. The unsettling resemblances between today's markets and the situations in 2000 and 2008 are becoming evident. In 2000, a surge in high-tech stock prices was trailed by a staggering crash, while 2008 saw a painful downturn in the U.S. housing market that almost shattered the banking sector. What adds to the concern is that this time, both the stock and real estate markets are on the verge of bursting simultaneously. A similar scenario unfolded in Japan during the early 1990s, triggering a prolonged period of economic stagnation that continues to impact the world's third largest economy. Japan went through nearly 2 decades of economic struggle, coupled with a subsequent lackluster decade. Past attempts to deflate bubbles in both the stock and real estate markets simultaneously have ominous implications. Concerns regarding the well-being of the U.S. commercial real estate sector have intensified over the past few weeks. The real estate industry, heavily reliant on debt financing, has been significantly impacted by the escalation of interest rates. The rise of remote work has especially taken a toll on office spaces, leaving the market in what Grantham described as ragged disarray. The U.S. housing market, which achieved record-high prices in 2022, is now experiencing a decline due to the surge in mortgage rates. The good news for investors. For investors, a positive aspect exists amid the equity bubble in the U.S. and the overpriced nature of the stock market on Wall Street. Jeremy Grantham suggests that seeking undervalued stocks in developing markets, along with some more affordable developed nations, would be a wiser approach compared to maintaining an extensive holding of U.S. equities. If you decide to hold U.S. stocks, it's advisable to opt for high-quality stocks with strong financial foundations. This is particularly crucial since situations like these can potentially evolve into financial crises, as they have done before. In essence, just as you'd look for deals when shopping, aim to identify stock bargains rather than paying premium prices. The emphasis should be on avoiding expensive markets and costly stocks. Investors should prioritize the concept of value and affordability based on what they receive. Search diligently for countries with lower valuations and within them, identify the most economical stocks. Maintaining a portion of your portfolio as cash reserves is wise, as it might lead to excellent buying chances. Most importantly, overcome the fear of missing out and the overpowering desire to chase after profits, especially during the concluding stages of major market bubbles. Also, investors should exercise special caution when dealing with cryptocurrencies. Bitcoin, in particular, lacks real utility and has been surpassed by a newer generation of more intelligent and efficient cryptocurrencies. Many of these, however, don't adhere to the traditional method of generating profits, although a few do. While the fundamental concept of cryptocurrencies might endure indefinitely, it's evident that much of their current value as a store of wealth is misleading. It cannot genuinely be considered a dependable store of value. It's universally acknowledged that the volatility associated with cryptocurrencies is extremely high, mirroring the behavior of high-risk stocks with significant fluctuations in value. If you find this video informative, like and subscribe to this channel for more educational content. Let's continue. The era of elevated corporate profits is coming to an end. In the long term, stock values will confront the influence of two factors that have historically propelled them upward. One factor is higher inflation. Considering the inflation levels observed in the U.S. since the middle of the previous year, a significant stock sell-off should have already occurred. The assumption was that historically low interest rates would have to rise. However, the market seems to be dismissing inflation, believing it's merely temporary, even though indications suggest otherwise. If this perception of inflation shifts within the market, the result could be a ruthless decline in price-earnings ratios. Jeremy Grantham anticipates that the projected 50% crash in U.S. share prices might occur gradually over an extended time frame, as opposed to being a rapid and immediate sell-off. This scenario could potentially lead to a prolonged struggle, where the market gradually adapts to rising inflation and interest rates. Another element seen as a potential drag on share prices is the potential decline in the current record share of economic output that goes toward company profits. Profit margins have been averaging 30 to 35% higher than they had been in the preceding 50 to 60 years. Several factors have contributed to this trend, such as increased corporate influence, lowered taxes on capital-related elements, dividends, interest rates, capital gains, and a notable level of regulatory capture by corporations. Consequently, concentration within various industries has risen, and prominent companies like the FANGs, Facebook, Amazon, Netflix, Google, have attained a status akin to instant monopolies. While this has favored profit generation, it hasn't been as beneficial for overall economic growth. This monopolistic trend isn't limited to one economy, but is observable globally. Such a situation might bolster profits, but it's not as conducive to economic expansion, and governments are beginning to express concerns about this monopolistic landscape. Jeremy Grantham's insights into the potential crash that could reshape our generation's financial landscape are both thought-provoking and cautionary. The world is marked by rising inflation, shifting profit dynamics, and increasing monopolistic trends. Grantham's analysis offers valuable foresight into the challenges that lie ahead. By understanding the factors at play and heeding Grantham's observations, we can better prepare ourselves for the evolving economic terrain and find opportunities amid the changes. If you found this video insightful, don't forget to like, subscribe, and hit the notification bell for more empowering content.